Good day, everyone. For today, we will discuss the first topic under Intermediate Accounting 1, which is cash and cash equivalents. By the way, our discussion on this course, Intermediate Accounting 1, will revolve or will focus on the current assets of our statement of financial position. And the first line item of our asset section is our current assets, and under current assets, we have the cash and cash equivalents. Before we proceed with our discussion on cash and cash equivalents, I would like to share with you the course outcomes of Intermediate Accounting 1, which is for number 1, apply applicable financial accounting standards and disclosure requirements relative to the asset section of the Statement of Financial Position. Number 2, report the proper amount and items included in the current asset section of the Statement of Financial Position, or what we call the balance sheet. To achieve these course outcomes, we have here learning outcomes. Okay, number 1 is to explain cash and cash equivalents. Number 2, determine the items considered cash and cash equivalents. And number 3, account for petty cash fund transactions using impressed and fluctuating fund systems. Okay, let's start with our discussion about cash and cash equivalents, particularly with our discussion on the cash items. But before that, let's have here a guidance from PAS 1, paragraph 66. It says that an entity shall classify an asset as current when the asset is cash or a cash equivalent unless it is restricted to settle a liability for more than 12 months after the end of the reporting period. So the paragraph says that cash or cash equivalent is classified a current asset if it is not restricted. Okay, so I highlighted here current cash or cash equivalent, and then I also have here a red font that it should not be restricted or unless it is restricted. So it means if it is restricted, then you cannot classify cash or cash equivalent as current. Okay. Okay, particularly restricted to settle a liability for more than 12 months after the end of the reporting period. Okay. Okay, let's move on. Let's discuss about cash. I know you are very familiar with cash. You encounter this term or this account title in your senior high school, in your fundamentals of accounting, even in your other accounting courses, in especially financial accounting and reporting. And as you know, cash includes the bills and the coins. But it's not only the coins and bills that we consider cash. Okay? So it's beyond that. So in accounting, cash includes money and any other negotiable instrument that is payable in money and acceptable by the bank for deposit and immediate credit. Okay? And what includes or what comprises cash items? Number 1, cash on hand. Okay, you are very familiar with this cash on hand. So you have here the coins and bills. What else? You also have here a check, an example of manager's check, and another check, okay, a customer check. So a customer check is the check issued by your customer as payment of their obligation to your business. Okay, when we say cash on hand, it refers to undeposited cash collections, your cash collections on hand, okay, basically, and other cash items awaiting deposit. What are those cash on hand? Okay, as mentioned, we have here coins and bills, the customer checks, cashier's or manager's check, traveler's check, bank drafts, and money orders. Okay. Number two is cash in bank. So as opposed to cash on hand, which are in the custody of the company, cash in bank is the cash in the bank. Okay, basically in the bank. We deposited in the bank. And we have your example. So this is an example of a checking account in which your money in the bank is in the current account or the demand deposit account. And you also have here a savings account or savings deposit evidenced by a passbook or an ATM or both. So for our cash in bank, we have demand deposit or checking account and savings deposit. Okay, you have to take note of this, that for deposits in foreign bank, which are subject to foreign exchange restriction, should be classified separately among non-current assets and thus the restriction clearly indicated. If you can still remember the PAS guidance that I shared with you, that in order for our cash or cash equivalents considered as current asset, it should be unrestricted. So meaning it should be or it should not be restricted. Okay. Okay. Another topic related to cash in bank is bank overdraft. Okay. Let me share with you a case here. So assuming that for case one, you have a deposit at BDO and you open an account, particularly a demand deposit or current account. In your books, you have a debit of 90,000, meaning you have a deposit to BDO at 90,000 or amounting to 90,000, and you have also a credit of 100,000, or you have issued checks amounting to 100,000. So the effect is that you have a credit balance of 10,000. So your BDO account has a credit balance of 10,000, and based on the record, you have issued checks in excess of your deposit. So your net balance is 10,000, and this is called an overdraft. So it is a current liability. Okay, another case is when you have an account in one bank and another account in another bank. So let's say aside from BDO, you also have an account at BPI. So for BDO, the same in our case one, you have a net balance, net credit balance of 10,000, and that is a current liability and overdraft. Then you also have here a cash in bank BPI, a debit of 110,000 or 110,000, and a credit of 10,000 with an ending balance of 100,000 or a net debit balance of 100,000. Okay, so how will you present it? Your cash in bank BPI should be recorded as part of current asset, so 100,000. And your current liability, bank overdraft BDO, 10,000. So the thing is, you cannot offset your negative 10,000 from 100,000. Okay? There is no offsetting. Okay, in the Philippines, we do not permit bank overdraft. However, in our case too, there is an exception. So we say that for every rule, there is always an exception. So while our case one, an overdraft is not permitted in the Philippines, in case two, we do not permit offsetting, but there is an exception. Okay? So exception to the rule on overdraft. We have here a case three. So assuming that instead of having an account with BPI, you have another account in the same bank, BDO. So let's say in BDO account one, you have a checking account. In account two, it's a savings account. Okay, assuming that you have still a negative 10,000 or credit balance of account one, and you have a 100,000 net debit balance in your account two. Is that permitted? Or can you offset the balance of these two accounts? Okay, so an overdraft can be offset against the other bank account, number one, when the entity maintains two or more accounts in one bank and one account results in an overdraft. So that is permitted. So for our case three, you can offset the balance. And if the amount is not material. And under IFRS, bank overdraft can be offset against other bank account when payable and demand and often fluctuates from positive to negative as an integral part of cash management. Okay, another topic related to cash in bank is what we call compensating balance. So what is compensating balance? This is the minimum checking or demand deposit account balance that must be maintained in connection with a borrowing arrangement with a bank. For example, the entity will borrow 1 million pesos from BDO. And based on their agreement, there should be a 10% maintaining balance as compensating balance. So what does it mean? So the 1 million pesos that the entity will borrow will be reduced by an amount equivalent to the 10% agreed compensating balance. So it results in the reduction of the amount borrowed because the compensating balance provides a source of fund to the bank as partial compensation for the loan extended. So instead of receiving 1 million, the entity will receive net of 10% compensating balance. So 10% of 1 million is 100,000. So that's 900,000 pesos. Okay, that's the amount that will be received by the entity as a result of their borrowing arrangement. Okay, and how do we classify compensating balance? It depends. It could be classified, number one, as cash if the deposit is not legally restricted as to withdrawal because of an informal compensating balance agreement. Okay, cash. What else could be classified as current assets, particularly cash held as compensating balance if the deposit is legally restricted because of a formal compensating balance agreement and if the related loan is short term. Okay. If the related loan is long term, it will be classified as non-current asset. Okay, so let's recap. Compensating balance can be classified as cash if not legally restricted. Current assets, particularly cash held as compensation, if legally restricted and related to short term. Then non-current investment if legally restricted and the loan is long term. Okay? Okay, next topic is about checks. So another topic related to cash in bank, particularly our demand deposit or checking account. So I want you to focus on the sample check that I will share with you, particularly on the date of the check, because the date of the check will determine what type of check is that. Okay? Okay. So assuming that today is June 8, 2023, and the company, the entity, prepared a check, drawn a check, dated on June 8, 2023, today, assuming that today is June 8, 2023. So what do you call that check? That check is called dated check. And if that check was given to the supplier the same date, the supplier can encash immediately. Okay? And if that is the case, so the cash in bank of the company will definitely reduce. However, if the dated check is undelivered or unreleased check, so what does it mean? It means that the check was merely drawn and recorded but not given to the payee before the end of the reporting period. So it is as if the entity did not pay the supplier because the control is still the company which issued the check. So the payee cannot encash because they did not receive any check, right? So during the time the check was prepared, the entity debited accounts payable or any appropriate account, example, 8,400 based on our illustration, and then credited cash in bank. However, since the check was not given to the payee, so what will be the adjusting entry? Debit cash or cash in bank, 8,400, and you credit accounts payable or appropriate account. So please take note that the check was not given before the end of the reporting period. Okay, let's move on. Continue. Next illustration, please focus on the date. Instead of 2023, it's 2024. So what did you notice? The check bears a future date. If you receive this type of check, supposing that you were the payee, can you encash the check? Definitely not, because it bears a future date. And we call that check post-dated check. This post-dated check was drawn, recorded, and already given to the payee, but it bears a date subsequent to the end of the reporting period. And what was the entry when this check was prepared? So same in our previous example, the entity which issued the check debited accounts payable or whatever account is appropriate, 8,400, and then credited cash or cash in bank. Okay, so since the check bears a future date and the payee cannot encash it until it's June 8, 2024, so the entity should have an adjusting entry. So referring to the entity which issued the check, debit cash or cash in bank 8,400 and credit accounts payable or appropriate account 8,400. Okay, next, we have another check. Please check the date of the check. It's June 8, 2022, last year. So what do you call this check? We call this check stale check or check long outstanding because if you were the payee, you cannot hold the check for a very long time because the bank usually have a period within which you can encash the check. And based on banking practice, it's within 6 months. Since it's June 8, 2022, and now it's 2023, July 2023, so it's more than a year. So meaning the check was considered or is considered a stale check. And this check was not encashed by the payee or is not encashed by the payee within a relatively long period of time. And the bank will not accept the check for encashment. And usually, the entity which issued the check should reissue another check. So in the case of this stale check, when the company or the business which issued this check prepare this entry, debit accounts payable, 8,400, and then credit cash or cash in bank, 8,400. And it is correct. The thing is, the payee did not encash it during the time or during the period when it should be in cash. So as a result, the entity which issued the check should prepare an adjusting entry. So debit cash or cash in bank, 8,400. Then credit accounts payable or appropriate account, 8,400. And then if the entity will reissue a check, then it will record a debit to accounts payable and then credit to cash in bank, 8,400. Okay? So that's stale check or check long outstanding. Okay, another item under cash, you have cash fund. And cash fund is a fund set aside for current purposes or to finance current operations. And what are those funds? Okay, I have here petty cash voucher, which is a document used for petty cash expenses. So therefore, we have a fund for petty cash. So we have petty cash fund. We also have payroll fund and dividend fund. So these are examples of cash fund. Okay. Please take note that cash fund set aside for non-current purpose or payment of non-current obligation is shown as long-term investment. And again, if it's for current operations, we consider that as part of our cash items. Okay, another thing you have to remember is the classification of a cash fund. Again, it could be current or non-current, and it should be aligned with the related liability. Okay, please take note that for sinking fund set aside to pay a bond payable should be classified as current asset when the bond payable is already due within 1 year after the end of the reporting period. And another thing is for cash fund set aside for the acquisition of a non-current asset. So what should be the classification? It should be non-current regardless of the year of disbursements. Okay, a recap for our cash items. It includes cash on hand, cash in bank, and cash fund. And how do we measure cash? Definitely it's at face value. However, it can also be measured at current exchange rate if the cash is in foreign currency. And it can also be measured at estimated realizable value if the amount recoverable is estimated to be lower than the face value if the bank or financial institution holding the fund is in bankruptcy or financial difficulty. Okay? Okay, let's move on. Cash equivalents. Okay, this is the guidance for cash equivalents. According to PAS 7, paragraph 66, short-term and highly liquid investments that are readily convertible into cash. Okay, so that's cash equivalents, highly liquid. And how can we say, so what's the criteria in short for highly liquid investments? How do we say, or how do we know if the investments are highly liquid? So what's the criteria? Okay, so this is the criteria for highly liquid investment. Okay, only highly liquid investments acquired 3 months before maturity. So this is the criteria. Acquired 3 months before maturity can qualify as cash equivalents or if the term is actually 3 months. Okay, what are the examples of our cash equivalents? We have here 3-month BSP treasury bill. So the term is originally 3 months. Number two, 3-year BSP treasury bill. The original term is 3 years, which is long term. However, purchased 3 months before date of maturity. Again, take note that even if the original term is more than 1 year, but if it's purchased 3 months before date of maturity, then that's part of cash equivalents. What else? 3-month time deposit and 3-month money market instrument or commercial paper. Okay, let me share with you more about money market where these securities or cash equivalents are traded. So money market is where the low risk, highly liquid, short-term debt issued by governments, financial institutions, and corporations are traded, meaning the issuer of these money market securities are governments, financial institutions, and corporations. And why they issue these securities? Basically, they need funding and they need money from investors. So that's why they issue these securities. So in exchange of these investments, the investor will receive compensation in the form of interest income. Okay. The maturities of these debt securities typically range from 1 day to 1 year, but are often less than 90 days. Debt securities because the government's financial institutions and corporations are basically borrowing funds from investors. Okay. And these are examples of debt securities. We have the treasury bills and commercial papers. And an example of marketable securities or short-term investments, not marketable securities, but short-term investments with 3 month term. You have time deposits. Although in time deposits, it could be more than 1 year, but basically there is 1 month, 2 months, or 3 months time deposit. Okay. Let's discuss further about treasury bills. These treasury bills are known as T-bills, peso-denominated short-term fixed income securities issued by the Republic of the Philippines through its Bureau of Treasury. So as mentioned, if the government needs funding, it will issue treasury bills through a Bureau of Treasury. But it's through the banks where the entity can invest in treasury bills. Okay, the original tenors are 91, 182, and 364 days. And for some banks in the Philippines, they issue a confirmation of sale to the investor, or this is the document to evidence the investment in treasury bills by investor. And upon maturity or any time the investors desires to sell back the T-bills, investors are required to surrender the COS to the bank. And how does the entity earn from treasury bills? The T-bills are sold at a discount, meaning below the face value, with the interest paid in advance. So the entity earn interest income. Okay. Next, how about commercial paper? Commercial paper is a common type of short-term debt instrument issued by corporations. Okay, if the government issues treasury bills for corporations or for non-government securities, it's commercial paper. So just like in treasury bills, commercial papers are issued at a discount and matures at its face value. And the entity which invests in commercial paper will earn an interest. Okay. How about time deposits? Time deposits are not debt securities because these are not issued by government or corporations who need funding. It's actually the money of the entity. So they just chose to invest in time deposits because if they will just deposit their money in the bank, in regular savings account, entities or businesses are aware that the interest is low. No? So this time deposits is a fixed term investment account that allows the business or allows you to grow your money with higher interest rates compared to a regular savings account, although the T-bills or commercial papers yield a higher interest from time deposits. Okay. Usually there is a certificate of time deposit issued to the investor. Okay, next topic, let's move on. Accounting for cash shortages or overages. So when do we say that there is a shortage, cash shortage or cash overage? Okay, you will just we will be comparing the cash count from the balance appearing in our books. If the actual cash count is more than the balance appearing in our book, then it's cash overage. More than. But if it's less than, the cash count is less than the balance appearing in our book, then there is a cash shortage. Again, let's start with cash shortage. If the cash count is less than the balance per book, shortage. If the cash count is more than the balance per book, overage. And how do we account for the differences? Okay, normally we use a temporary account or suspense account to adjust balance per books to actual balance. And we use the term or the account title cash short or over. And how do we do that? Assuming that there is a cash shortage. So we will just be decreasing our cash in our books. So we will be crediting cash. And then we will debit cash short or over. Okay, how about cash overage wherein the actual cash count is more than the balance per book? We will just debit the account title cash. So we debit cash and we credit cash short or over. And what happens when you prepare this entry every time there is a shortage or overage? So you have an account, cash short or over in your books, which should be closed out. So the question is, in what account will you close your cash short or over? Okay. Okay, just a recap. This was our entry when we prepared our adjusting entry for cash shortage and our entry when we prepared when there is a cash overage. Okay, the next step is you have to close out your cash short or over to proper account. Actually, it depends. If there is a cash shortage and the shortage is chargeable to cashier, okay, we have an account title due from cashier or receivable from cashier. Or if it's due to loss, okay, you have loss from cash shortage, and then you credit cash short or over. How about overage? if the cash was found out to be the money of the cashier, okay, you have a credit of payable to cashier, or if it's attributable to miscellaneous income, then you credit miscellaneous income and then you debit cash short or over. So this is how you close out your cash short or over to proper account. Okay. Next is how do we present and disclose our cash and cash equivalents? Okay, the presentation is that this cash and cash equivalents as the first line item under current assets. And in terms of its composition, the details comprising the cash and cash equivalents should be disclosed in the notes to financial statements. And let me share with you an actual example of the FS presentation and disclosure of cash and cash equivalents. This is the consolidated statement of financial position of Jollibee Foods Corporation, which I downloaded directly from their website. So you can see in the consolidated statement of financial position, the cash and cash equivalents appeared as the first line item under current assets. And there is an open or close parentheses, note 6, 31, and 32, meaning the details of which can be found in our notes 6, 31, and 32. And in the next slide, this is the note 6, where you can find the composition or details of cash and cash equivalents. So for Jollibee, the composition includes the cash on hand, their cash in banks, and their short-term deposits. Okay, so if you will notice, it's the same 24,692,675. Okay, so that's how we disclose in the notes the cash and cash equivalents. Okay, last topic, we have impressed system. Second to the last. This is a system of control of cash which requires that all cash receipts should be deposited intact. So assuming that the cashier's collection for today is 1 million. So that 1 million will be deposited the next day to the bank. So that's how you implement the impressed system as far as cash receipts is concerned. How about cash disbursement? So this is self-explanatory considering that for cash disbursement should be made by means of a check. But not all cash disbursement is through check. Okay, so you will learn that later. Okay, let's move on to petty cash fund. Earlier, we learned that petty cash fund is a cash fund used to finance current operations, and this is considered as part of cash. Okay, this petty cash fund is money set aside to pay small expenses which cannot be paid conveniently by means of check. So remember in impressed system, so the disbursements are evidenced by means of a check, but not all disbursements should be paid by check. So we have small expenses which cannot be paid conveniently by means of check. Imagine if you will pay 30 pesos or 50 pesos of expenses and you have to pay through check. It's very convenient. That's why we have a petty cash fund to pay small expenses. And as to methods of handling petty cash, there are two. We have the impressed fund system, which is the commonly used system in handling petty cash transactions. And we also have fluctuating fund system. What is impressed fund system? So let me share with you this basic transactions transpiring for petty cash. No, for petty cash. So number one, or as far as petty cash transactions are concerned, number one is a check is drawn to establish the fund. So if we have this transaction, there is a required journal entry. Okay. Number two, payment of expenses out of the fund. Under impressed fund system, you don't have to prepare a journal entry, but a memo entry only, just a note or a sentence regarding the expenses. And then number three, replenishment of petty cash payment. So that's the time that you will prepare a journal entry. Okay. And number four, at the end of the accounting period, it is necessary to adjust and replenish expenses in order to state the correct petty cash balance. So you will have to prepare a journal entry. And number five, an increase or decrease in the fund is recorded normally, meaning if there's increase in fund, you have to debit petty cash fund. If there is a decrease in fund, you have to credit petty cash fund. Okay? Let's have an actual example or is an illustration for our impressed fund system. So let's say November 10, 2022, the entity established an impressed fund of 10,000. So basic, the entry is you debit petty cash fund 10,000 and you credit cash in bank 10,000. Okay, assuming that on November 29, the fund was replenished, the petty cash items include the following. So you have here the details. So what will be the journal entry? Okay, the journal entry will be the appropriate expense account like supplies, 5,200, telephone, 1,800, and postage, 1,000 pesos. The credit is cash in bank, 8,000 pesos. Please take note that in replenishment, you do not use petty cash fund as your credit, but instead cash in bank. Okay? And every time that there is payment of expenses out of the fund, remember under the impress system, there is no journal entry, but a memo entry. So what will you do? The expenses will only be recorded under impress system when there is a replenishment of funds, okay? Or there is a replenishment of fund, okay? And December 31, the fund was not replenished. The fund is composed of the following. So this is the end of the accounting period. What will you do? Okay, you will just need to make an adjusting entry to reflect the actual petty cash fund balance. So you have to debit supplies, postage, miscellaneous expense, and you credit petty cash fund 3,500. However, the next period, you will be reversing the entries you made on December 31. Okay? So the adjustment made on December 31 is reversed. So you debit petty cash funds, okay, same amount as last December, and then the details same. Okay. How about the next month, the fund is replenished and increased 12,000. So assuming that the supplies went up to 3,900, the postage 900, and miscellaneous expense 1,200. You will need to include another debit of petty cash fund because you will be increasing the fund to 12,000. So you have to debit 2,000 petty cash fund and your cash in bank is 8,000. So that's how you prepare entries under impressed fund system. So how about the fluctuating fund system? Okay, so same scenario, same transactions. So how does it differ from impressed fund? Okay, in your payment of expenses for number two out of the petty cash fund, under impress system, there is no journal entry. But in fluctuating, there is a journal entry in which you will record the actual expenses. Okay, actual expenses out of the petty cash fund. And then for number three, there's also a difference in number three, replenishment or increase of the fund. Okay, especially in replenishment of fund. In impressed, if the fund is replenished, that's the time the expenses are recorded. Okay. In fluctuating fund system, there's no expenses to be recorded in number three, but a debit to petty cash fund. Okay. I'll share with you the actual transaction sample. And then number four, at the end of the reporting period, no adjustment is necessary because the petty cash balance is already adjusted. Because every time there is a transaction affecting petty cash fund, the account title petty cash fund is used, okay? And then number five, decrease or increase of the fund is, or particularly decrease of the fund is reverted back to general cash and there is a journal entry. And if there's an increase, of course, there's also a journal entry, okay? So in short, decrease and increase of the fund, a journal entry is required. Okay, let's have an example. So for an entity, when it established an impress fund of 10,000, or it's not impress fund, yes, it is impress fund. Okay. Okay, or the entity established a fund of 10,000. What is the journal entry? Same as in the impressed fund system, you have to debit petty cash fund 10,000 and you credit cash in bank 10,000. And then during the month of November, 11 to 28, these are the petty cash disbursements amounting to 8,000, and the details are shown here. So how do we record the petty cash disbursements? Under the fluctuating fund system, you have to already recognize the expenses. Okay, you debit appropriate expense account like supplies, so telephone and postage, and you have to credit petty cash fund of 8,000. So meaning your petty cash fund balance is already adjusted, right? So under impressed fund system, just a memo entry. Okay. So that's why next transaction. Okay, let me share with you. The next transaction is the issuance of check for 10,000 to replenish the fund. So at this point, you will be recording petty cash fund 10,000 and you will credit cash in bank 10,000. So this is um, opposing with our impressed fund system. In contrast with impressed fund system, we're in when there is a replenishment of fund, that's the time when we recognize expenses. But here, under fluctuating, you will be debiting direct the petty cash fund amounting to the amount of 10,000 and then you will credit cash in bank 10,000. So at this point, the petty cash balance per book is 12,000. Okay? So these are my references for our for my discussion this session. And if you want, you may answer this activity one objective type. This is a true or false. Only 5 questions. You go to Kahoot and then you type game pin a number as shown on your screen. Okay? You can answer this activity anytime you want. And then you also have activity number 2, problem solving. So you have here the details of cash on hand, petty cash fund of these items. And then the question is, you have to determine the total amount of cash and cash equivalents that will be reflected in the statement of financial position. So every time there is a problem solving, you go directly to the question because you may be overwhelmed with the data given, but check first the question being asked. So the question is cash and cash equivalents. So what will be your procedure in determining the cash and cash equivalent? So you have here the table. So your task is to determine which of these items are included in our cash and cash equivalents. Okay, and then you also have this 4 additional information. Which of this information affects our cash and cash equivalents? Okay. So after you have determined the transactions that will affect your cash and cash equivalents, then you can proceed with the amount of cash and cash equivalents that will be reflected in the statement of financial position. And if you have already the answer, you may comment your answer and check if you provided the correct answer. Okay, so that would be all. Well, thank you. You may subscribe to my YouTube channel or subscribe my YouTube channel, Miss Kath, at Catherine Limoco 1423. Okay, that would be all. Thank you.